Thank you very much. I guess the objective of this panel is really to take forward some of the points that were raised earlier by the two speakers, Howard and John, and hopefully delve deeper into some of the key themes that are driving the markets. Now, if I could just first invite the three of you quickly introduce what you do and what macro means to your business so that the audience can understand where your perspectives are coming from later on. Stephen, start with you.
Yeah. Sure. We look after multi-asset, mainly income strategies for Asia. So we've been doing it for 75 years, and income is our main thing. Macro means everything to us, from asset allocation to security selection. So it's the key thing for our income strategies.
Okay, Mike.
Thank you. Hi, I'm Mike. I'm from M&G. I'm an investment director for our multi-asset and equity business. Our episode macro strategy is designed to be a buy and hold but tactical asset allocation strategy to put in clients' portfolios to help them develop a sense of staying investing, but being able to respond to changes in the market. We think a bit differently to how some people do in the macro space. We're based heavily on behavioral finance, so we like to think about when the market is throwing a tantrum, such as maybe what's happening with bond yields in the last few days, and is that the right time to be thinking about taking the contrarian position and positioning ourselves against that?
Hi, I'm Helen. I do family office investing at Fung, and we've been doing basically single family office investing for a few decades, and recently started to do some multifamily office investing as well. We're in both public as well as private. Private, we mainly allocate to funds, although we do a little bit of directs, and public, we're doing basically global multi-asset. So, we have kind of a medium risk type of absolute return type of investment target, and we also have a lower risk credit fund. So those are the types of things that we do. So macro is very important to us in terms of the allocation between public and private, what kind of liquidity profile do we want, and because we have such an incredibly flexible mandate to be in any region, any sector, any asset class, we obviously have to use our allocation bullets very carefully. So we spend a lot of time on this.
All right, thank you very much. That's very clear. We've got different perspectives, different responsibility, and different asset classes. I think it's a great combination. And before we start the questions, can I just also congratulate Endowus for organizing such a successful event. Now, let's just start with the same question that Sam started with the conversation earlier. Let's wind the clock back in November last year. When you were planning for your investment theses, what were your base case scenarios? There was this discussion about how many rate cuts by the Fed at the time, but exactly to help you formulate your investment view for 2024, what were the key base cases, and what were you expecting? Yeah. Any surprises, say, for example? Stephen?
Sure. As we, get together and talk about how we want to handle the panel, I think we all, joke about at 1 second, when we look at the topic, the Fed, recession in China, think about Fed and recession. Now you don't get a lot of resonance from the audience, right? The previous speaker said if you go to the media and talk about recession, nobody's want to hear about it. But 6 months ago, or even same time last year, that's a whole new different picture. Right. People worry about hard landing, soft landing. They are not talking about no landing. So the narrative is pretty different. The Fed rate high, and I think we at the beginning of last year start going into the credit side of the market. When you get a coupon of 5+ on IG and 8+ on high yield, that gives you a very good proposition that you haven't seen for decades to go into the fixed income side compared to the equity side, especially for income investor like us, right? It's been, something that is so hard to find in the market. So I guess, if we wind back the clock for 6 to 9 months ago, we are definitely seeing a much more gloomy pictures in the state. But then, people are all talking about the Fed might start cutting interest rate earlier part of this year. But, that just a story keep pushing back. Now June is not likely. So I think it's just a very evolving pictures. We always feel the market is, too complacent about when it's going to start. But the essence of it is surprising on the later part of it.
Yeah, Mike, can I just write on that? So coming into this year, looking back, so how are you repositioning given what's happened in the last 3.5 months?
That's a great question because we're obviously quite a tactical approach to macro investing. We'd actually summarize the last 9 months as being part of a more longer term shift in what's happening in markets, going back to sort of the 2021 period, that we had this traumatic event with rates going up so aggressively as they did, and it's still having ripples through the macro environment. So if you asked us back in November what we thought, we were getting heavily long duration. We thought that the sell-off in October displayed elements of what we would call a behavioral episode. People getting an element of getting too scared about what was going to happen. There's stories around fiscal discipline, steepening yield curve, were sort of manifesting themselves in an accelerated sell-off in bonds. So we went aggressively long duration. We trimmed that back in late December, going into January. We still have some duration. But actually, in the last week or so, we've actually added back to that. But rather than being at the long end of the curve, we've added back to it at the short end of the curve. So we have this thesis that when the market likes to throw its toys out the pram or have a what we call an episode, that we're asking, is that a rational response to the data in the market? What was said up front about the pundits being on TV predicting recessions, we don't put a lot of faith in that. As portfolio managers, we're not here to have a view on what's going to happen in the world to make people, to fill column inches. We're here to generate return and manage risk. So when we feel like the odds are tilted in our favor, we can move into that. So it's been quite a interesting 2024 for us in terms of moving on that duration. I'd say the other one that surprised just quickly is Japan. That everyone expected the BOJ to move, and the BOJ did move, but then the yen has done nothing. And then China is the other one that we've played, that coming into the year, the debt deflation demographics was really weighing on the market. We doubled our position in the Hang Seng and the HSCI at the end of January. That's bounced back, and again, that goes back to something that was said in the intro, which was you can have a good investment in a bad market if you're willing to be bold and you're willing to be tactical.
Helen, any thoughts on the remainder of the year, at least?
Yeah, I would say, the major surprise, I would completely agree, has been on the bond yield spike and then the stronger than expected dollar. And I think when you think from last year to this year, the big picture is actually still probably the same. It's just that things got further extended. But why did they get extended? Growth is still robust in the US, true. But I think the Fed has made it pretty clear that the rate path is going to be more inflation dependent rather than growth dependent. And if you actually look at the pop in yields in January, as well as the recent one, in the two sets of inflation data, the January one was owner's equivalent rent, which has actually normalized. And then this latest one is on transportation, which is auto insurance premium was the one that kind of really surged out of the blue. But again, that could also be more of like a one-off anomaly. So the market's moved a lot on the back of these things that are a little bit difficult to explain, and so we don't actually know whether these sticky indicators are going to remain sticky after a couple of months. So I would actually add to those positions and not necessarily capitulate, similar to what we were talking about just now. But the other thing that I think is really interesting that people maybe not have talked about is that, yes, the U.S. economy is still robust as expected, but the services side, you do start to see some cracks in terms of the consumer. It's not like everything's so rosy, right? You do start to see some companies miss in a pretty significant way, and it's not yet clear whether it's widespread or whether it's brand specific. But one area where we have seen positive surprise is that PMIs for manufacturing industry, secondary industries, whether in the U.S. or in UK or the rest of Europe, except for Germany or even in China, have started to pick up. So last few years has been like service has been on fire, but manufacturing has been disastrous. And now we actually start to see an inflection in that. So if the market does manage to kind of resuscitate itself because rates are going to come down and it's just temporarily higher, et cetera, what's going to have the leadership? Is it still the same tech names and services companies that we saw last year, or is it going to be something that's much more cyclically depressed previously and maybe has room to run further into the rest of the year? Or maybe all of these emerging market and Asia currency victims that we've seen from the dollar strength. So those are the areas that we'd be more interested in looking at for the rest of the year in terms of risk reward, rather than just buying up the same stuff that we had seen previously last year.
Well, a lot of points has been packed in the three comments there. And by the way, I'll be keeping an eye on my iPad about the questions that are submitted here. So please feel free to do so. Okay, Stephen, going back to you. In your space, particularly in the credit space, credit quality is actually one key barometer when it comes to measuring the cycle. What are you seeing from your perspective when it comes to, you mentioned IG versus non-IG, and also to the point about duration, float versus fix. What are your preferences? How do you see the outlook for the rest of the year?
Good question. And maybe even a step back, right? Because we are multi-asset managers, so when we look into a company that we like, we actually look across the capital structure. Honestly, a few years ago, before the Fed rate hike, we don't see a lot of opportunity that we can get on the credit side. Why? Still remember, at the beginning of COVID, you still see high yield giving you nothing more than 4% in terms of coupon for companies that are basically out of business, right? Cruise company, right? For example. So these are the environment that we've been in for decades because of the suppressed interest rate, right? So as an income investor, we are basically don't have a lot of choices but to take up equity, even we like the company. With the rate high, I would say that normalize things. Now you see basically if we like companies, say banks, we can think about getting some of our largest bank in the state with a reasonable dividend, or you can also get their IG, give you a coupon of about 5+. You don't have to worry about the banking crisis in the state. You don't have to worry about whether their earnings can beat the expectation, and that gives you just way more ways to get exposure for the same company that you like. So going back to that, I think that is that thinking that drive us moving a lot into the credit side as the Fed start to normalize the interest rate, and you see the spread in both IG and high yield start to pick up and normalize 2022 and span towards 2023. So to your other question about fixed, floating, or even a lot of investors asking us about public versus private, right? I see we feel there are opportunities in all market. We just see is say public versus private. If you can get high yield now for a coupon of somewhere around 8 to 9, the bar for getting into the private market becomes high, because at the end you are compensating for the daily liquidity. So I would just say let's not talk about even say leverage being a major component for private market returns, right? Just comparing at what the private market can offer you now make us feel that it's been an opportunity that we haven't seen for a long period of time.
On the private credit side, since you touched on that, maybe Helen, can I bring you in on the private credit space? It's very hot topic these days, very popular, and some may argue quite crowded. What's your view?
Look, I think in terms of the absolute level of yields we're able to get now because of where we are in the rate cycle, then it's absolute basis very attractive. In terms of the credit spread, it's not that attractive right now in public or in private, right? In public, we're talking about kind of basically the narrowest spread in the last X number of decades, basically back to 2021 when everything was, abundant liquidity everywhere. So I would say credit spread in public is not attractive. Credit spread in private for senior secured stuff has gone from maybe 650 to maybe low 5s now. So probably also slightly below the median or mean level. But obviously, we do think that on an absolute basis, it's still relatively attractive. And there's quite a lot of fundraisings and different types of products out there. Our view is get some exposure to that because the risk is relatively low and the return seems to be fairly decent. But on the other hand, we also have to recognize that there hasn't been really a major credit cycle for a very long time. So a lot of the track records look great, but you really have no idea, right? Because there hasn't been a cycle. So we would actually probably diversify a bit and get exposure to a number of names rather than put all of your eggs into one basket. That's the way that we look at it.
Understood. Okay, Mike, if I could turn to you. The title of this panel actually is Fed, Recession, and China. We know we already talked a little bit about Fed. We know what to talk about in China. And as Stephen was saying, I don't know where are we seeing the recession, but maybe in a more broader sense, Mike, where do you see is the biggest sort of risk vulnerability you see in the global markets that you would keep watching? And also, a very similar question just popped in, quite related, which is that market vol, top investor challenge. How do you implement your asset allocation and hedging in terms of countering all these risks and volatility, and also maybe recession or some sort of downside risk to your portfolio?
Let's take the second part of that first. I mean, vol is important in terms of understanding your propensity to accept risk is the way we think about it. We often find the best opportunities is when vol is spiking, which is, exactly when certainly the wealth management community find it hard to invest in a asset class which is undergoing a period of short-term volatility. They're the best buying opportunities. But then the hindsight bias would be, oh, I would have bought equities then, or I would have bought equities then. So what we try and do with episode macro is make those hard decisions for the clients. We try and be dispassionate, and we try and make the tactical asset allocation decisions to do that. So adding duration in October last year was a very complicated client conversation where everyone's going, but the news is telling us that the bond market is falling apart and you should never invest in this again, and the yield curve's got to steepen and China's never going to buy any treasuries again. And we're like, yeah, but the yield looks pretty good and we're going to buy some. And then when we were up 10% in November and December, they were like, oh, that was a good move. Now, that's what we're trying to deliver. Now, the vol in the market, the bond vol has stayed high. The move index, as people like to refer to, has stayed pretty consistently high across it. And this, we would say, has spoken to this continued recalibration of beliefs around what is an appropriate yield for the market, what is our star. And then nobody really knows. And until they can find a new anchor, we get into these periods like we saw from summer through to late October, and then again from October through to January, and more recently again here, where people are sort of suffering with this PTSD in the bond market, where it is like last year, in all honesty, the part of the sell-off in October was a lot of people sitting around going, I can't be losing money on my safe haven assets for the third time in 3 years. My boss have fired me, so we capitulate out of the market. That level of capitulation drives opportunities for us. So on the volatility side, we would say that equity vol has started to pick up. It's nowhere near where it is. I think VIX is about 18. It's a little bit above long run averages, starting to get interesting. But we've seen a much more rational equity market in the last few years. The irrationality has been in the bond market. Where do we see the risks? The risks really come, I would say, it depends on your duration positioning. So the risk to our portfolio is that the yield curve steepens, that inflation turns out to not just be sticky but accelerating, or that growth turns out to be a lot higher and the yield curve has to steepen. The diversification that we have in treasuries right now, we would say would insure us against some of the geopolitical risks. Would insure us against the fact that these long and variable lags are not very fashionable to talk about anymore. About 3 or 4 months ago, they were very fashionable to talk about, but now nobody wants to mention it. The CRE problem in the US looks contained. Maybe that flares up again. Maybe the market decides that it wants to take a stronger look at that and goes, well, actually, no, there is an impact on anything beyond the regional banking. We don't know that risk, but we'd say from where bond markets are right now, you're getting paid a decent amount of yield to have that diversification.
All right. Moving on to the Fed, we covered quite a lot actually, and I think mentioned by Howard earlier about now the market is predicting maybe 2 rate hikes for the balance of the year. I think it was mentioned that one house actually predicted a rate hike for the balance of the year. A few now starting to think about at least staying put. In terms of I think with the sticky inflation, market is still going to be in this guessing game for at least in the next 3-4 months. Any thoughts on how, from a positioning perspective, from a hedging or volatility perspective, what are the instruments that would help you to weather the storm? Maybe Mike, I come back to you, and then Stephen, and then.
On the sort of path of rates, we've seen that big shift, as I mentioned, from sort of November 1st to December 31st to today. When we were discussing this internally in January about what the Fed futures were pricing in when it was sort of 6 cuts, it seemed like a pretty unsteady equilibrium. It felt like it was an average of 2 groups of people, some who thought there'd be no cuts and some who thought they'd be cutting close to zero because we're going to have some cataclysmic recession. So it always felt unstable, and now it feels like we've shifted to one end of that distribution. And in that respect, it feels like the market is more fairly pricing the outcomes. The fact that we have heard one bank come out and say maybe rates go to 6.5%, it means at least it's in the lexicon of people's minds that there is this risk out there. So the price probably already really reflects it. Where you tend to get the best odds for hedging is when nobody's thinking about it. So 2021, we went short US Treasuries in March, and everyone thought we were idiots for 6 months until the prices started to move. And that was based on observation that the bond market was looking at the strong data coming out of the US and going, we're not really too bothered about this. And us saying, well, that feels like an ill-considered reaction to the data. Now, aside from the last few days, the gradual rising in yields has been relatively orderly until the last few days. Now that's got us interested to say that actually probably we've gone too far, and we'll be a buyer of that.
Helen, you want to go first?
Yeah, I think we usually have to trade against wherever the consensus view is, and consensus view at the beginning of the year was 160 basis points of cuts. Now it's 39 basis points, so that's a really sharp move, and the rates fall has really spiked in the last few days on the back of geopolitical and other types of news. So we actually think that some ways to firstly, I think with equity vol being still quite low, it's a good time to actually hedge, especially the stuff that's gone up quite a lot, where it's basically for whatever the fundamental, the valuation can be whatever you want it to be, right? So that kind of stuff we think is good to hedge at the moment, while the hedging is relatively cheaper. We think that treasuries is a good way to hedge at the moment, given the credit spread is not that attractive. So maybe more interested in treasuries versus before. Receive fixed if you want to bet on basically the long end normalizing a little bit. I think steepener on the rates front, I think is quite interesting, because earlier people, steepeners usually work when you're getting closer to the rate cut cycle, and recently it's completely reversed, right? And now I think it's probably gone a little bit too far again. So yes, recently we did have this March CPI pop, but again, we're talking about splitting hairs, like 3.5 versus 3.4. It could just be a little bit of rounding, and then we have the geopolitical news. But honestly speaking, even if geopolitics gets worse and oil supply gets dented to some extent, the amount of spare capacity in OPEC Plus now is 5 to 6 million. So that is basically the highest level ever, except for that couple of months during COVID, right? So there's lots of spare capacity. If demand starts to go down further, I don't think that they're going to cut to like 10 million or something to prop up the price. And frankly, if oil goes to 100, there is going to be demand destruction anyway. So I don't think that we have too much risk that like oil is going to surge another $20 and push yields up further. So the risk reward, we think, for some of these hedges is probably better now versus it's been in a number of months.
Stephen, anything to add on your side?
No, the only thing I would add is, we talk about consensus, right? Just like, the consensus has been so wrong, just like Powell has been so wrong about inflation all the time, right? So, we've been quite mindful about, what the consensus has been guiding us for the rate cut. And, it's really like, what the investor want to achieve with the fixed income position. We still have lots of institutional investors, especially those in Hong Kong or Greater China, try to think about what, fixed income position that they want to add, simply because their goal is focusing more on the carry, which has been attractive for the past few years and remains so. Obviously, if you're a pure fixed income, fund manager or portfolio manager, you worry a lot about the hedges and then the duration play against the benchmark. But for a lot of the asset owner, simply look at the carry. Yeah, the spread is tight, and obviously the yield curve, we need to think more about that. But the carry actually has been quite attractive for a lot of the asset owner, especially if they have, say, an endowment that they look for the spending rules, or just, a lot of the investor with a longer term liability. So it could be as simple as that. So that will be the only thing I want to add.
Great answer. You actually covered one of the questions on the panel already, on the iPad already. Now, switching gears to China. I think, we did hear a little bit from both Howard and also from John earlier. But, I mean, there's been a big roller coaster, let's just say. Last year, the key theme was China investable or not? And then this year, there's a lot of discussion about, the spare capacity, exporting spare capacity. But China in itself, as you can see from the media and also from the sort of policy statements, I mean, they are going through a transition, right, into a more lower growth at a more lower level, at least at a lower rate, but at least higher quality growth, right? So this is a transition that's been going through. They've been going through valuations. I think, Mike, you alluded to earlier, it's quite attractive, and that's why, Mike, you said you added the late January. So Helen, can I come back to you on China? With the current valuation, what sort of catalysts are you looking for in terms of positioning for a turnaround in the China market? Let's start with equities first and then in general, yeah.
Sure. Look, I think there's two things to look at with China. One is the cyclical and the other is the structural. On the cyclical, I think the expectations are quite low already, right? We've seen basically China take extremely aggressive deleveraging steps, taking all the potential measures that they could within a very short, abrupt period of time against the property sector. I think there's very few places where you would see the sales, the investment, the new start, the land sales all come off by very large percentages within a space of like 12 months. Basically purposely induced by the government itself. LGFV, trust, and shadow banking, and all of these things have been addressed very aggressively, internet, antitrust, et cetera. So China has basically taken advantage of 2021 and maybe parts of 2022 when the economy was still doing quite well to really try to deflate a lot of these bubbles preemptively. The result is that the cyclical aspect is not great, and people recognize that, and that's been very negative for sentiment towards even the higher quality growth, which is the consumption, right? Because if your property prices are coming down, then your negative wealth effect kicks in, so it's a little bit difficult to control. But expectations on that, I think, are very low. Positioning is very low. Valuation is very low. So I'm not too worried about that aspect, and I do think that the policymakers are inflecting in terms of saying, okay, that's kind of enough, and let's start to do some more supportive policies as well. The structural side, though, I think is going to be very difficult to address, and I think the key catalyst is this third plenum, which could have happened in the fourth quarter of last year, or should have happened in the fourth quarter of last year, but is still continuously delayed and has to happen by the end of this year, but nobody knows when. They haven't announced, and people are hoping there's some reform, out of expectation, reform progress. I think that would be the key positive catalyst. The key negative catalyst, which unfortunately isn't until later, is the election and what Trump is going to do with tariffs and whether there's going to be a 60% tariff against China or not. Maybe it's just election rhetoric, and he recognizes that that would be totally irrational and really not good for anyone. We hope so. But that overhang is still going to be there for some time. So I think the third plenum could help, but I don't think it'll drive a huge 50% re-rating or whatever the potential could be until we actually clear the Trump risks at the end of the year or beginning of next year.
Right. Can I push you a little bit on this point, because you mentioned about policy catalysts, right? Do you think there is a disconnect, or in terms of market's expectation of what the market hopes China's policy can help, versus what the policymakers in China actually thinking about their own policy settings when it comes to supporting their own economy? Maybe the cyclical versus structural policy response there. Any thoughts about market's expectation on policies?
I think the market expectation on both cyclical and structural are very, very low. So, and in fact, people do expect there to be R cuts, rate cuts, and so on, but no one really expects it to have any meaningful impact. So the policymakers may need to come out with something a little bit more administrative and use more creative tools in their toolbox to actually jumpstart the confidence. You do see that their fiscal spending, infrastructure spending, et cetera, and some of the subsidized manufacturing fixed asset investment, I think that's starting to kick through. And also obviously a lot of stabilization of the capital markets itself, directly or indirectly. I think those have kind of put a bottom in terms of the L. But I don't think that a lot of people have any expectation regarding any kind of V at all. And on the structural, I don't think anyone's talking about any reforms for a very, very long time. Basically, people have zero expectation on this. So it's almost like if there's any kind of announcement, that would already be a pretty significant positive surprise.
Mike, you want to add from a tactical perspective, maybe?
Yeah. China's a good window into how we think really in terms of investing, and without wishing to sound flippant, as investors, all we're trying to do at the end of the day is buy low and sell high. Now, it's usually the low points are characterized by cheaper valuations and extreme pessimism around a market. They're characterized by behavioral biases around people not wanting to invest, loss aversion, framing from the media saying that this is the worst market in the world. And what it takes is sort of the emotional fortitude to go and make that decision at the time. So what do we get excited by as a contrarian investor is when we see big negative numbers on the screen in a market that we don't own, because that's usually where a market is capitulating and there's a buying opportunity. So China looked like that through most of the summer in 2022. And then we ended up eventually going in the end of October of 2022, and then it rallied significantly on the COVID reopening. And January 2023, every investment bank put out their 2023 outlook, and China was top pick, and we closed our position. We went back into it in January this year again because you had that feeling of capitulation amongst the international investment community about it. So the China is uninvestable of October 2022 became China debt deflation and demographics of 2024. And again, it just felt overblown. And from a tactical point of view, you look across all the equity markets in the world, you know, the Hang Seng, HSCEI were only one sort of trading on single digit multiples. And you're like, actually, that looks pretty interesting for a tactical, you know, approach right now. You don't have to have a long-term view on what is going to happen with policy. You just have to have a belief that the terrible is going to get less worse and you get a big re-rating as we've already started to see.
Stephen, anything from your side? China, your space?
My space will be even much more simple. Like, you know, there are a lot of companies like, you know, CSI 300 Universe that we like that are less affected or more isolated by the geopolitical policy shift, that kind of thing. You know, there are stocks that we like, valuation are cheap, but relative to their peers in Japan and India, we just find way more attractive, you know, stock that could be, you know, helped by some of the momentum tailwind that could benefit in the shorter term. And as a result, you know, these are not attractive. I think being right too early is equal to being wrong. And, you know, we need to wait for, you know, there's sufficient signal that the other market participants are going to agree with us before we can feel more comfortable getting in more on the China space.
Right. Okay. Let's turn a little to how the macro themes are impacting your decision when it comes to private versus public. You, Helen and Stephen, you both touched on that a little bit earlier. I guess in the alternative space, there is a panel later on. Actually, there are quite a few panels that are covering some of the themes we have been talking about. But particularly on private versus public and the alternative space. Any thoughts from any of you? Helen, maybe, or Stephen? Yeah. Helen, you go first.
Sure. So I think in terms of the public space, right, we've been thinking for quite a while that emerging markets in Asia has decent risk reward, but that the U.S. market was getting a little bit overheated. And so in that regard, we were not super keen to chase at the end of last year, or, you know, when basically people think that the economy is never going to slow down and there's basically no landing and everything's going to be, you know, rosy forever. So we do think that probably we can wait a little bit further, and it's not necessarily just because of this recent yield spike that might be temporary, but also probably more that at some point you do see the U.S. consumer and the U.S. economy starting to lose a little bit of steam. Like, you don't necessarily want to chase when people think there's no landing. You want to chase when people think that there could be a hard landing, but there's not a hard landing, right? So that's what we want to wait for on the public space. In the rest of the world, I think, especially, you know, whether China or the rest of Asia, et cetera, everybody's been dragged down because of the strength in the DXY, right, in the U.S. dollar. So from a cyclical perspective, to the extent that that eases off a little bit, I think is going to help the rest of the world a lot. And any kind of rebound in manufacturing and PMIs is going to help the rest of the world more than it helps the U.S. So I think this is a decent entry point to look at public for non-U.S. type of exposures. On the private side, you know, there's a lot of opportunities now in the secondary side because of, you know, all the pressure from flows and endowments and so on. So we do see some interesting, attractive, discounted supply, probably more interesting and attractive versus some of the primary stuff. And a lot of the primary stuff is not really happening at this minute anyways. You know, if you look at US LBO space, people are starting to deploy, but the entry valuation levels are not that attractive versus before. So you do have EBITDA growth and M&A growth, but the kind of entry to exit multiple expansion opportunity or the very cheap financing opportunity that we had over the last 10 years may not necessarily be there either. So we would be selective, I think, on both fronts.
I mean, all agree. The only thing I would say is, you know, I think people need to recognize simply because the interest rate environment has been changed, a lot of the private market will be getting more challenged. All the good vintage that we've seen, you know, is being built on an environment with a very long period of low interest rate, very high valuation, sustainable from that perspective. When now we are having more high interest rate, maybe higher for longer, that challenge everything, and that is the tailwind for secondaries. Real estate, private side will continue to be challenged, especially for the state. You know, industrial could be the exception, but all the offices, you know, and the, you know, residential will continue to be challenged. Credit, again, you know, seeing a lot of interesting opportunity on the private side, but back to the first point about, you know, how much illiquid premium you want to pay for the liquidity when you can get meaningful, attractive, you know, return from the high yield space. That would be the only point I would like to add.
Mike, you want
Not so much a comment on public versus private, but I would say on active versus passive. I think we're entering probably one of the great periods for active management. I'll go on record as saying that. The period after the GFC, when rates were kept artificially low, was a terrible time to be an active investor, and we saw the ETF market clean up. Now there's scope to have a differentiated opinion. Doesn't mean everyone's going to be right. By definition, some people are right, some people are wrong. But if you pick your managers carefully, it should be a very fruitful environment to them. And slightly self-servingly, we're seeing that on the tactical asset allocation side, where institutions who've been very much stuck in the 60-40 mindset for the last 15 years sort of got woken up in 2022 when both asset classes were down. And actually, what do we do how do we incorporate more dynamic management, more tactical management into our portfolio, and how do we do that from a governance point of view, whether that's for a wealth management client or whether that's for an institution? They still face the same hurdles of wanting to be dynamic with their allocation, but not really necessarily having the tools in the toolbox to do it.
Right, it's a question about generally asset management, and it's a nice question to close our panel. When it comes to achieving the goals, investment goals and strategy that you want to implement, what are your considerations when it comes to the investment costs, origination, expertise, and operations? So, in a word, my understanding of the question is, how do you execute? Is that a...
I mean, we're pretty straightforward. We run a tactical macro strategy. We predominantly invest in futures. Liquidity matters to us. We want the ability to change our mind. We want the ability to trade. We don't trade that frequently, but when we do, we want to be able to shift position in meaningful size. So we're predominantly at the most liquid, transparent end of the market, and we're really trying to generate our alpha from making those tactical shifts between equities and bonds. We can go long and short, so the flexibility of derivatives is very beneficial to us.
The only thing I would add is, so you used that talk about 2022, and I think that's an excellent example when both equity market and fixed income market are down, like for a good period of 2022, like how you are going to navigate that. So we managed, say, about 80 billion of multi-asset, and over the course of 3 months, we've been moving 20% of the equity into fixed income and doing that kind of asset allocation. And think about it, we are talking about 16 billion of the capital that you need to move in 3 months. And when we are talking about scale of that, execution, how to make sure transaction won't eat into your performance, and how to get it right and the right timing all becomes important, when you talk about execution. And that's the only thing that comes to my mind when you talk about the execution side of things.
Yeah, Helen.
I think we're a little bit different from some other, asset managers that are more relative return focused. We are really focused on over the medium term, over the cycle, getting solid returns that are from very diversified sources and not too concentrated, not too high risk. And the most important thing is that we don't lose a lot of money in the bad years. It's okay if we don't make too much money in the good years, because we don't want to have too much risk in one area. But so long as you don't lose too much money in 2022, and we barely lost hardly any because of having a lot of cash position as well as yield stocks, et cetera, then actually over the cycle you actually compound quite well and end up doing quite well, even if you do relatively, compare yourself to multi-asset, et cetera. So I think that's on the public side. And obviously with the ample liquidity pretty much everywhere except for some emerging markets, that's not really an issue. And we do shift our portfolios around a lot. Because I think it's the asset allocation that probably makes the bulk of, the majority of the difference in terms of the returns. So we want to be very flexible around it. On the private side, I would say the sourcing, we have a 6-person private team within Trinity, so we don't go out and source direct deals and lead them on our own. So we rely on our GP partners. On the private side, I think probably what's more important is that we pick the right vintage funds, right? So if you bought into a lot of, cloud funds in 2021, then maybe it's not the best vintage, but in other vintages for different types of assets, you might have better returns. Obviously, we also rely on our GP partners even after they raise the capital to deploy it at the right stage over the coming 3 to 5 to 7 years. So those are some of the things that we look at, and then over time we work with them to see what kind of deal flow they can bring us in terms of co-investment opportunities. So I think vintage and asset allocation makes a difference on the private side as well.
Great. That's actually a great way of closing the panel. We are pretty much finishing on a dot. I invite all of you to thank our panelists for such a great discussion, and hopefully it sets the scene for the rest of the panels. Thank you very much.